Up more than 2% yesterday, up more than 2% this morning. Live from New York City. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, we begin with the big issue, mounting signs of capitulation.
What is happening now is very extreme.
Companies are battening down the hatches and getting ready for choppier times.
You're seeing very strong bearish trends across multiple asset classes.
Broadly bearish outlook for risk assets.
Something that for most people is very uncomfortable.
When I look at the earning analyst estimates, they're still too high.
Expectations coming down.
That should be the next shoe that drops.
We need to see some of that weakness coming through.
If you really start thinking about what's going on in the U.S. economy,
the Fed is trying to hike and crack the economy.
We've seen the market sell off a lot.
If we're not bottoming out, we're sort of finding a bottom.
That potential capitulation.
Nobody ever nails it on the exact day, and if they do, they're lucky.
These signs of capitulation are building. That's the read from Bank of America's latest fund manager survey. For more, let's get to Bloomberg's Taylor Riggs. Hey, Taylor.
And it's always a great survey, John. And when you think about capitulation, some of these one-sided trades are what really has been built into the market. A lot of this has been a drop in market liquidity that the survey has noted, the same number that looking at a weaker economy, inflation that's going to be falling in the next 12 months, 83% looking at global profits to worsen over the next 12 months. So all of that is signs of some of these one-sided trades and what is built in. The most crowded trades, John, you could have guessed this, right? Long dollar, long ESG, long oil. Long dollar means short EM and unfortunately short EU equities as well, as you're thinking about some of the economic and recessionary environments on the way as well. Take a look, though, at some of the tail risks, John, because it's always the left tail, the type 2 error, how to not lose money. That is the key focus. As we know, it is all about inflation. It's all about hawkish central banks, what that error might look like. And again, sort of those deep global recessions, what that means for the big Fed pivot and making sure that inflation is under control. If we're also looking at sort of a big inflationary environment, the left tail risks is what you have to look out for. Finally, John, it always comes back to the Fed, right? And some of the big macro outlooks. Where do we see the terminal rate? Where do you see the Fed going to and holding at and pausing before a cut on the end? As you can see, a lot of this has been raising expectations from maybe now 4.25%, 4.5%, even 5% for some big terminal rates here. So that really is going to be the key for the equities going forward.
Hey, Taylor, wonderful. As always, Taylor Riggs there breaking it down. Michael Hartnett and the team over at Bank of America. Here's the quote for you. It screams macro capitulation, investor capitulation, the start of policy capitulation. He points to the cash levels, 6.3%, the highest since April 2001. With us now, Kelsey Barrow of JP Morgan and PGIM's Greg Peters. Kelsey, first to you. Are we seeing macro capitulation, investor capitulation, and the start of policy capitulation?
So where I would push back on that assessment is policy capitulation. I think when I look at what's been happening in the gilt market, which has really been driving global market sentiment, the one thing that I really have taken away is that the BOE has never backed down. They are continuing on with QT. We think that's going to happen at the end of the month. And when we look at the big picture, the fundamental data in the U.S. is still suggesting that the Fed needs to continue to push on with rate hikes and QT. What the market has been really struggling with is this risk of financial stability and this idea that the Fed is going to pause because financial stability risks are rising. And what I would say to that is there's two things here. There's cost of liquidity and there's access to liquidity. Right now, with the cost of liquidity, it's going up. That's monetary policy. That's what the Fed and other central banks want. Access to liquidity, you may not like the level that you can raise liquidity, but you can still get it. As long as that access to liquidity is open, central banks are comfortable with financial stability and they can continue on with their path of hiking rates and removing accommodation.
Greg Peters, do you agree?
Well, so I think it's way too early to say capitulation. I mean, I think that's heroic in many different respects. I mean, we're not even close to a recession that everyone predicting once again, basic principles, Jonathan. I've yet to see markets rally, risk markets rally, heading into a recession. So to me, I think it's really quite too early. And as it's been the entire year, hope springs eternal, and everyone's looking for the turn and been finding it the entire way.
Not finding it in the banks right now. Just listening to the Wall Street chiefs on the US economy. Greg, this is what they've got to say. Brian Moynihan at Bank of America, consumers are spending, they have money. JP Morgan's Jamie Dimon, consumers are in very good shape. Jane Fraser over at Citi, the US economy remains relatively resilient. What are we learning about now that tells us something about the future, Greg, about the state of this economy and how it can deal with a downturn?
Yeah, so the underpinnings of the economy here in the U.S. is really quite robust. The consumer is humming along. Wages are up, obviously not keeping up with inflation, but the nominal growth matters a lot for the economy, and I think we forget that sometimes. So what that means to me ultimately is that the Fed has to do more to slow down the demand side. And so if anything, this is a good news, bad news story. The good news is the economy is doing well, consumers are doing well at all. But the bad news is the Fed has to do more in order to quell that underlying inflation that comes with it. And so it raises the specter of a hard landing, I think, as a consequence.
Kelsey, you call a recession inevitable. Why is it inevitable?
Well, I would agree with what Greg is saying in terms of the Fed needing to do more. And unfortunately, because the Fed needs to do more, they need to keep policy restrictive for longer. The risk of a hard landing in that scenario just goes up. So when I look at the last CPI report, you see core CPI 6.6%, but the 6-month run rate is even faster than that. So we've had 300 basis points of tightening, and inflation is actually still accelerating. So when I look at fixed income valuations right now, I see very high yields, but I see spreads that are still very complacent to that risk of recession. And so, where we're most cautious is on that higher or on that lower quality high yield company that is still going to face a lot of trouble as the Fed pushes on.
Kelsey, I've said you say a few times you need to be patient here. Wait for spreads to get to maybe 750. I heard that from your colleague Bob Michael as well. What's special about 750 for high yield spreads?
So when we build up to those types of numbers, what we're thinking about is a couple things. One, where we expect defaults to move to in this cycle. And the second is the concept that markets tend to overshoot. So, even if you think that the default cycle this time around is going to be more modest, we know that likely the markets are going to overshoot. They're going to go a little bit further in that frenzy of really fully pricing in recession. And so that's the level that we're thinking we're getting to once we combine those two factors.
Greg, we had this discussion last week, didn't we? Spreads aren't screaming recession of 500 basis points. And then it's just really tempting to look at the yield that you can get right now in fixed income and say, forget the spread, just buy it. Greg, how do you navigate that particular situation?
Well, so you have to bifurcate the risk. I think that's what's happening is that investors are looking at the overall yield, which is a repricing of the risk-free and even the liquidity in the marketplace. Credit spreads themselves remain arguably pretty tight. So they're just above the average. That 750, 800 on high yield harkens back to a time when once spreads get past 800 basis points, high yield investors have been rewarded historically for entering the fray. But I think it's really interesting that investors are conflating the yield versus spread risk. And so yields are up. That's great news, absolutely. But you haven't seen a repricing in the cyclical part of the market, the default risk part of the market. And so I think spreads are still too tight here.
When do you expect to see that adjustment, Greg? And what's going to get us there? What's going to lead us towards that further adjustment in fixed income, towards what you just explained?
So I think it's data-driven, not surprisingly. It's been fighting the entire time, as I mentioned before. So I think the data has to soften. You have to start to see earnings roll over, margins compress, and so it has to become a fundamental story. So as of right now, it's just been a central bank repricing story, not a fundamental story. So I do think at some point that has to occur. If the thesis is that central banks globally have to hike in order to contain inflation and best slow down the economies and into a possible recession, then that has to filter through credit spreads. So I think it's just a matter of time. So I suspect, Jonathan, over the next 3 to 6 months.
Futures up big time this morning, up 2% on the S&P 500, up big time yesterday as well in the equity market. Kelsey, a question for you on the economic data. Just looking at the incoming information, maybe looking back to CPI last week, is this market still responding to the incoming data in a way that you would anticipate?
So we've had strong CPI. We had the strong September jobs report. You know, I think what's been muddying the waters a little bit has been the moves in European and UK bond markets, which has been creating a lot of term premium volatility. So one thing that we've been noticing is as the BOE has been repriced, it's caused the belly of the yield curve to cheapen. And I think that's stopped some of the yield curve flattening momentum that we've been seeing. I think that's probably coming to an end here. So we've seen a lot of headline ping pong from the UK, but I think at this point, given what we've seen in terms of the walking back of the budget, gilt volatility can come down, and we can see some of that stabilization in global term premium, which can allow the yield curve in the US to go back to that flattening trend and trade more with the domestic fundamentals, which again, strong labor market, high inflation, the Fed pushing forward with rate hikes, increasing recession risk, and that flatter yield curve.
The whole curve shifting lower this morning. Yields are lower by 4 basis points on a 10-year, 397 on a 2-year, down 3 or 4 basis points to about 440. Kelsey Barrow, Greg Peters sticking with us. Kelsey mentioned the UK coming up, a sharp U-turn on Trussonomics.
Now, I recognise we have made mistakes. I'm sorry for those mistakes, but I've fixed the mistakes.
That conversation up next.
Now, I recognise we have made mistakes. I'm sorry for those mistakes, but I've fixed the mistakes. I've appointed a new Chancellor. We have restored economic stability and fiscal discipline. And what I now want to do is go on and deliver for the public. We were elected on the 2019 manifesto. I'm determined to deliver on that.
The Prime Minister Liz Truss issuing a mea culpa following a U-turn on her economic plan. This coming amid a Financial Times report saying the Bank of England would also deliver a little bit of a U-turn and push back its plans to start QT. The Bank of England, a spokesperson for them, denying the report. The team coverage starts right now. Bloomberg's Guy Johnson in London alongside Lizzie Burden. Lizzie, this is getting more embarrassing by the day.
It is. Do you mean for the Financial Times or for Liz Truss?
Hey, Lizzie, you're taking that jab, not me.
The Bank of England has denied this report. You'll excuse me, I used to be a print reporter. But the Bank of England has denied this, but I have to say that it may not have yet decided to delay quantitative tightening. Doesn't mean it can't still happen. The problem with it is if they were to delay quantitative tightening, then they can't really be truly getting on with monetary tightening, and it makes the bank look as if it's beholden to fiscal policy. And Andrew Bailey at the IMF made very clear that he wants to get on with the job of inflation fighting. I was speaking to a former Bank of England policymaker last week, and interestingly, he pointed out that the Monetary Policy Committee isn't voting on this QE measure, QT, for financial stability. And it's a bit of a grey area, the oversight of all of this, and it is impacting on inflation fighting. So perhaps that's a measure that the Treasury Select Committee needs to have a look at.
Guy, the intraday range on sterling again, cable, the low 112.56, the high 114.10. It's been one of those sessions again, Guy, all over the place.
Yeah, I think increasingly, though, this feels less about kind of what we've been worried about over the last few days. Yes, we're a little all over the place. Things are going to take a little while to settle down. But I think the broad brush kind of policy changes have happened. We heard from the Prime Minister. I do wonder, I'll take the other side of what Lizzie said. I do wonder whether the Bank of England is floating trial balloons at the moment. It did so maybe during the thick of the crisis when it talked about maybe extending the assistance that it was going to offer. And now maybe we've got some commentary around the possibility of QT being delayed. So I just wonder whether there is something going on here. It doesn't look particularly good for the FT, but nevertheless, I do wonder whether the Bank of England is just testing the temperature here. In terms of the ranges, yeah, I think they're calming down. I was talking to Van Rom again on our rates team, talking about what is happening here. Looks like the 2-year, probably the rally we've seen there is sort of fizzling out a little bit. I think you're probably seeing that across the curve, John. I think probably the situation in the UK is past its most volatile moment. I certainly hope that it is.
You hope? Did you see the YouGov poll this morning, a couple of hours ago? Most Tory members say Liz Truss should resign. Next line down.
Yeah.
Boris Johnson is the most popular successor. Lizzie Burden, can I get your response to that YouGov poll earlier this morning?
Well, we knew that Liz Truss was in office but not in power. Interestingly, now 2 newspapers have stopped backing Liz Truss, so even the right-wing press is turning against her. But she is almost safe in the knowledge that no Tory MP wants a general election, as that YouGov poll would suggest. They can't decide which candidate should take over from her. Sunak doesn't want to serve under Mordaunt. Mordaunt doesn't want to serve under Sunak. Hunt says that he doesn't want the leadership at all, even though Mordaunt and Sunak both look like they were auditioning for the top job in the Commons yesterday. And even if they could choose who would take over from Truss, the whole process of how to get there is even more hazy. So Truss at least can feel like she's safe for a little bit, but maybe there'll be another crisis which would jog them into action. That seems to be the only thing that could rock the boat at this stage. She just seems to be willing to delegate to her other ministers as long as she can cling on.
What a mess. Guy Johnson, Lizzie Burden, to the two of you, fantastic as always. Guy Johnson will pick things up in about 40 minutes from now. Cassie Barrow, the lessons of the last couple of weeks, looking over to the other side of the pond, what are they?
Well, I think that the 2 things that I've taken away from this crazy move that we've seen is that, one, this term premium is not going away. So even though we've seen this walk back in the mini budget, we are not seeing a subsequent retracement in yields to the same extent that we had pre the announcement. And at the same time, I think the other thing is on the Bank of England and their continued resolve towards QT. So we think that QT is still going to happen at the end of the month. But, they may do a little bit to help us out. We think that they may tweak QT a little bit to put less pressure on the long end and do a bit of a twist QT to help out the market and alleviate some of the pain in the long end.
Greg, would you go with that too?
Yeah, I do. I still think it's very much of an isolated event here. I know many market participants are trying to think, is this a playbook for other jurisdictions, other central banks? I don't think that's the case. I think that's completely off, to be honest with you. You look at what's happening here in the U.S. We're, entering midterm elections, which is not really being talked about. I expect less fiscal coming out if there is a turn in the House and/or Senate. So to me, this is very isolated, but it's really difficult to get confidence back. And I think the UK is on this steady decline, unfortunately, and this is just one episode in that.
Well, for a moment, Greg, it was the tail wagging the dog, and it shook some things up in USIG as well. Did you take any advantage from what was taking place in the last couple of weeks off the back of how this one materialised?
Yeah, so I mean, that was the story. So with the UK LDI unwind and the liquidity that was needed and the selling pressures that we've seen globally, right? So, I mean, the collateral pool was outside the UK. It was in Europe and the US. And so we saw lots of bid lists and unwinds. And so, yeah, so tactically, we and others did did take advantage of that. And so I think that's the lesson here, in that you want to have enough liquidity to take advantage of these episodic events that actually kind of present opportunities. So we don't think it's over. We still think there's asset allocation changes, more to come on the UK LDI front. And I think that's the opportunity set, not these broad sweeping macro plays, but more of these idiosyncratic moves.
Kelsey, do you agree? Did you do the same thing in the last few weeks?
Volatility, it's hard, but it does also create opportunity and opportunity for alpha, for active managers. So we have absolutely been taking advantage of the swings in markets, of the risk on and the risk off, the periods that we have dislocations in order to find attractive opportunities and take advantage of them. And to do that, you need to have a nimble, active stance. You do need to have some cash available on hand to take advantage of those moments. But this is a market for active bond managers.
Kelsey Ferro, Greg Peters, the two of you, just brilliant, as always. Two of the very best in fixed income as we march towards the open and bound. Just a monster move in the equity market. And the data pretty decent too. Upside surprise on industrial production, month over month up 0.4%. The survey 0.1. Manufacturing production up 0.4%. The survey 0.3. Futures up by more than 2%. Up next, the morning calls, and later, BlackRock's Kate Moore is not adding any equity exposure right here. Would she fade this move? We'll catch up with her in just a moment. From New York City this morning, good morning. This is Bloomberg. Stocks up, yields down. That's the story this morning. Good morning to you. About 20 seconds away from the open and bound. Equity futures elevated, kicking higher by more than 2% on the S&P. On the Nasdaq 100 up by 2.6%, building on some monster gains in Monday's session this Tuesday morning, advancing once again on the Russell by more than 2%. That's the price action in the equity market. That was your opening bell. Here's the price action in the bond market. Yields are lower by 2 basis points on a 10-year, 398.80. The FX market, euro showing a little bit of strength at 98.67. Euro dollar positive, 0.25%. Crude lower by 1.4%, 84.26. We'll talk about another SPR release potentially later this week. We'll get to that in about 10 minutes' time. I need to talk about Goldman. That stock is up higher in early trading by more than 4%. The CEO, David Solomon, saying the following: this one is, quote, a challenging operating environment. Sonali Basak back with us for more. And Sonali, they've met that challenge.
I think we have to define challenging here. You're looking at trading figures up 11%, fixed income higher than everybody else on Wall Street by a percentage jump basis, and equities by revenue higher than its peers. Now remember, Morgan Stanley has traditionally led that business. JP Morgan won it last round, but now you're looking at Goldman take a little more share when you look at the equities business in a down market. Even with investment banking revenues down 57%, you have to look at advisory also, that is coming in at nearly $1 billion, which is pretty remarkable for an environment like this. It's really debt underwriting that missed on expectations, but you have to ask all the banks here, how much risk are they willing to take on? And do we have to watch when investment plans get crunched down in the wake of a very challenging environment, as we've been talking about? Look at this revenue breakdown, pretty remarkable here as well, because consumer and wealth now accounting for 20% of the business. Consumer revenues alone came in $100 million more than had been expected. Now, in the reorganization, what does that look like? What they've telegraphed is consumer operations are aligning a little bit more with the technology-focused businesses. They have that Apple partnership. They're focusing on transaction banking. Wealth is being brought into asset management. A new line of leaders being elevated, and a big change ahead for Goldman Sachs as we look to the reorganization, but no new targets yet set for those businesses. Here are those combined numbers there. We've been talking about it. The competitive pressure is on. You mentioned it this morning. Goldman's headcount is up 4%. So to the extent that you're seeing that crunch on Wall Street jobs, it's there, but it's not there in full.
Sonali, wrap it up. How would you grade the quarter? All the banks are in.
All the banks are in. It's a tough one. The consumer is more loved by the investor right now. But how do they feel in the middle of next year if Jamie Dimon's hurricane comes to fruition and the consumer gets crunched? That's the question. Investment banks are crunched too. Which one wins?
Stock is up right now, 3.9% for Goldman Sachs. Sonali, as always, fantastic over the last few days. Sonali Basak, our Wall Street correspondent. Goldman advancing. This equity market's higher by more than 2%. Every single industry group on my screen right now is positive. Consumer discretionary top of the pile up by 2.95%. Information technology up by 2.86%. The overall market looking at another second big day of gains on the S&P 500. Morgan Stanley's Andrew Sheets says this recent rally will be short-lived.
Maybe actually earnings season after a lot of negative guidance turns out okay, and you're into a window where seasonality for risk assets is often somewhat better. But big picture, we still have growth that's going to be slowing over the next 3 to 6 months. We still have a lot of monetary policy tightening ahead of us. So I think the way to think about this is a bear market rally. It's short, it's sharp, it still matters, but the big picture hasn't changed, and there's still work to be done, I think, before we can say this bear market's over.
Kate Moore of BlackRock echoing that view and keeping her cash stockpiles high. She writes the following: the weakening economic environment and tighter financial conditions create an unfavorable setup, and we are not adding to equities yet. We have built a substantial balance of dry powder as a hedge in preparation for any macro inflection points in 2023. Kate, I'm pleased to say, joins us right now. Kate, I was going through the checklist of yours. Management commentary on labour, CapEx, supply chain management. For earnings so far, what are you learning?
I think we still have to get through the bulk of earnings, John. We haven't learned that much yet. But it's going to be really, really challenging. Look, we have a world of economists out there who are all trying to sort through the data, to look into their crystal balls and forecast next year. And then you have corporate management teams who are saying, hey, my experience in the third quarter was not nearly as bad as I thought. One data point, not necessarily related to earnings, that I really love, because I love reading these CFO surveys, and the Richmond Fed Duke Fuqua CFO survey, which was released for third quarter data, had some interesting tidbits. And one of them was companies did not report any deterioration in their own conditions second quarter to third quarter. It was actually still relatively elevated. And while there's a big gap between how companies think about the economy going into 2023 and how they feel about their own businesses, that gap has persisted for a couple quarters. So there's not been a big deterioration. And I think it's going to be hard for companies to sort of give us strong guidance one way or another when there are so many macro variables that are uncertain, as Andrew Sheets was just mentioning in that clip you played.
Okay, it's something about what we can learn about the president, what it tells us about the future. And I'll build on that. This is what we're learning about the president from Wall Street chiefs. Moynihan at Bank of America says consumers are spending. Diamond at JP Morgan says consumers are in very good shape. Jane Fraser at Citi says the US economy remains relatively resilient. What that's telling most people is that we're in a situation where there isn't a ton of excess, there's not much fragility, and if we get a downturn, it won't be a bad one. Now, what I heard this morning, Kate, that was interesting from Andrew Sheets and Morgan Stanley, said, yes, maybe in GDP, but perhaps not in earnings. Could you build on that? Do you think there's a clear distinction there that might emerge that we need to pay a bit more attention to?
Yeah, I think it's a really good point. Look, we would always like to take GDP and, our forecast for GDP and kind of map it against earnings. But the truth of the matter is that, over medium-term periods and even over short-term periods, the correlation between GDP growth and earnings growth is very, very light, in some cases non-existent. There sometimes is a better correlation or relationship between revenue growth, the top line, and GDP growth. But companies have a lot of levers to pull and use in order to engineer better earnings. And I would expect if revenue growth meaningfully weakens and the inflationary pressures across a whole variety of goods and services don't ease, companies will do things like reduce headcount, slow down investment in different parts of their businesses that are not as profitable, all to protect the E. So you can have a weaker economic environment and actually a solid earnings environment. And, John, something you and I have talked about before that's also really important is the composition of the U.S. equity market, which is, some of the companies that are most important on the earnings side are less economically sensitive than, say, smaller parts of the overall market cap for some of these indices.
So let's fold that into the inventory story. We've heard from Target, from Nike, from Micron, potentially GM and Ford, according to UBS. Kate, how influential is that kind of story to the way you think about this equity market more broadly?
Yeah, one of the challenges I have, John, is that you have some of these companies talking about more difficult inventory environments. They have, over-ordered, or they got too much of one seasonal good. And they're going to look to liquidate. Now, on one hand, I'd say that's great for holiday shoppers, maybe a great time to take advantage of deals. On the other hand, it's pretty hard to take the examples or the stories from specific companies and extrapolate it out to the entire industry group, even though sometimes that's how the market's trading. Sometimes it's very specific around the ordering, the purchasing, and the price and sales of that specific company, and not about all of the consumer. You mentioned a moment ago, John, how many data points from financial services, from credit card data and stuff, all suggesting the consumer is still in quite good shape.
Yeah.
And that's our expectation as well.
So, Kate, you talked about the macro inflection point in 2023. That the dry powder for now was for next year. Why is that? Why is next year the thing penciled in on the calendar and not the last few months of this year?
Well, look, the truth of the matter is, John, we have a lot of high conviction equity holdings in the portfolio. So it's not as if we have cut all of our risk and just said we're going to wait until the first quarter of 2023. What we do own, we think, is are strong companies with huge free cash flow potential, will be able to maintain their margins through a tougher inflationary environment. But we've balanced that out with more cash so that we can be opportunistic. I agree, to the clip earlier with Andrew Sheets, that this is more likely a bear market rally than something that's sustained. And while multiples have become more attractive, there's a lot of question around the E. And you can't say the market is unequivocally cheap at this point. So I think we'll be averaging our way into companies we like that we want to hold for longer periods of time. But there's no rush to say, we're breaking out here into a new bull market.
Okay, I wanted to finish with a quote from Marko Kolanovic over at JP Morgan. This is what he had to say. We trim the size of both our equity overweight and bond underweight, but remain overall overweight equities and commodities versus underweight bonds. This is the line I'd love your feedback on. Our commodity overweight continues to serve as a hedge for geopolitical risk and inflation, and we stay long the dollar as a hedge to a hawkish Fed. Can I pick up on the first piece of that last line, Kate? Your thoughts on a commodity overweight as a hedge for geopolitical risks and inflation, and specifically expressing that through the equity market?
Yeah, I mean, look, we have a very constructive view on commodities and resources in general, and have actually begun to even rebuild some positions where we had taken profits in this space earlier this year, or a couple months ago, I would say. The part that's not in Marco's note there that's really important is the strong fundamentals for these resource companies. Yes, I think some of the commodity stuff provides a good hedge against macro uncertainty and perhaps some geopolitical risk, but we're also talking about companies that have very, very, very strong balance sheets. In fact, almost no debt, where the supply-demand balance is very strong, where there are secular tailwinds in terms of the transition to new energy and the metals and resources that are required for that transition. So there's a lot of fundamental reasons, in addition to the geopolitical and sort of volatility reasons, you'd want to own that space.
Kate, awesome to hear from you, as always. Let's catch up before the end of the year. I'm sure we will. Kate Moore of BlackRock there. About 10 minutes into the session, equities up 2% on the S&P, the Nasdaq up by 2.2%. Really big two-day gain on the S&P 500 to kick off this trading week. So we've heard from Kate Moore, called it probably a bear market rally. Andrew Sheets of Morgan Stanley, probably a bear market rally. And Erin Brown of PIMCO said this.
I absolutely would fade it. I think that the market right now is just coming off of, very strong weakness over the past week. We see a little bit of a relief rally this morning, but I wouldn't extrapolate that this is, going to last a very long time. I still think that there's significant challenges ahead as we turn the corner into early next year that the market hasn't digested yet. Earnings estimates are too high, margins expectations are too high, and I don't think that equities are still, singing from the same hymn book that we see in the fixed income markets.
Pushing back against this equity market move, the S&P still higher by about 2 percentage points. Up next on this programme, the Biden administration looking to take more action on gas prices.
He's worked so hard to get those gas prices down by more than $1 a gallon from the highest points that we have seen just a couple of months ago. And he'll continue to work on that.
That conversation up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Rolls-Royce Motor CEO Torsten Müller-Ötvös. That conversation at 10:30 a.m. Eastern. This is Bloomberg.
We understand that there are challenges that are in front of us here in this country. That is why the president has taken action to lower costs. He's worked so hard to get those gas prices down by more than $1 a gallon from the highest points that we have seen just a couple of months ago. And he'll continue to work on that.
President Biden looking to lower prices at the pump with midterms just 3 weeks away. This amid some recent reporting from Bloomberg revealing plans of another strategic reserve release to the tune of 10 to 15 million barrels of crude. Bloomberg's Josh Wingrove joins us now down in D.C. Josh, walk us through our latest reporting, please.
Yeah, Jennifer Jacobs, Jennifer DeLuey, and Ari Natter, our colleagues, John, are saying that they're going to announce, kind of re-announce, the pending release of that 10 to 15 million barrels, which is left over from the 180 million that they announced in the spring. Now, the big question would be whether they add stuff on top of that, either a new release or something else to make it look like they're going farther than they've gone before. Remember, in the spring, that 180 was supposed to get us till fall, when they said the private sector production would sort of, catch up and fill that million barrel a day gap. So, of course, after what has come since then is that OPEC Plus production cut, and it looks like they're kicking tires on what to do next. One of the economic aides, Jaron Bernstein, leaned pretty heavily in over the weekend to the possibility that this is coming down the pipe. Now, of course, the midterms are the backdrop here. John, you know this, that the gas prices are ticking up a little bit, and polls tend to pretty closely track voter sentiment with gas prices. When gas prices go up, voters get mad at the president, so definitely a political lens to this one as they try to, in their view, stabilize the oil market at least.
Josh, as you know, the SPR is at a 4-decade low. Is there a conversation taking place down in D.C. about how exposed this might leave U.S. energy security next year, beyond the midterms, if this gets drained down any further from here?
A little bit of one, but not much. When I referred to Bernstein's comments, he went out of his way to say, look, it's still more than half full, so we have a little bit of wiggle room here still if they want to use it. Now, if it's just that 10 to 15, John, essentially, again, they're just re-announcing or committing to going to the full 180 that they'd announced in the spring. That's probably a different kettle of fish than if they really go above that 180 number. But, as you know, Republicans have started to sort of circle around this, and so we'll see whether they go at this particular issue. Joe Biden, in other words, has room to go still with draining the SPR, but it's kind of unclear how far he'll go without further sort of pouring gas on the fire that you talk about, saying, hey, this isn't for this.
Hey, Josh, awesome to catch up, buddy, as always. Josh Wingrove down in D.C. And to Josh's point, separately, we're still considering weighing limits on exports of fuel in the United States too. The internal deliberations, I understand, continue. President Biden downplaying the odds of a recession. The view from Bloomberg Economics say it's 100% going to happen for a U.S. recession to take place in the next 12 months. Anna Wong joins us right now from Bloomberg Economics. Anna Wong, 100% going to happen in the next 12 months. Why?
Well, in our model, we see a significantly increase in probability of recession compared to our last update. When we did our last update in August, it was only 65%. So what drove this increase in probability? 3 factors. One, housing. We saw a sharp fall in housing permits as sales fall and construction companies decided to hold off on building more houses. Second, tightening financial conditions. The 2-year, 10-year spread has widened. Also, we see widening in high yield spreads. Also, the third factor is just that households now have a poorer outlook about the future. And whenever they do that they will start to increase their savings to plan for rainy days, pulling back spending in today.
Anna, where are you and the team on the depth of said recession? Because what we often hear on shows like this one is short and shallow. Short in duration, shallow in depth. What are you guys saying?
Well, our baseline is still short and shallow, just because we do see a lot of buffers still. And for example, I told you before, the state and local government have a lot of cash. We're estimating up to possibly $780 billion. But then I do think that there's a risk that this could be a deep one too, just because that the number one single best predictor of how deep a recession is how long is the duration of the recession. And usually when the Fed fails to cut rates early on, and if the Fed does hold the rates higher for longer and decide not to cut in 2023 despite a recession, that could extend the length of the recession. And if that's the case, then it's possible that this recession, judging by the cumulative decline in GDP, could be rather deep.
Hey, Anna, thank you. Anna Wong of Bloomberg Economics. That note yesterday got a ton of attention. Equities right now up 2% on the S&P. The Nasdaq right now up 2.27%. A lot of Fed speak coming up a little bit later. You get it from Bostic, from Kashkari. Mike McKee's got to break that down. Morning, Mike.
Morning, John. Well, the problem for the markets is for years, the Fed said we're not going to raise rates until inflation goes over 2%. Right now, they're saying we're not going to cut rates until inflation starts to come down. But that's not a measure. How long is that going to take and how far are they going to do? The markets are flying blind. Now, we know that policy works with a lag. You can see there that every time the Fed raises rates, inflation took a while to start coming back down, and it wasn't until we had a recession that happened. So is that what we're going to have to see this time? We do have a busy week of Fed speak. A lot of people on the calendar. But here's the problem with the calendar. A lot of those are introductory remarks, welcoming remarks, things like that. There's only a few people who are speaking actually about the economy going forward, including Kashkari today, as you mentioned, Charlie Evans Wednesday, Patrick Harker on Thursday. We do get the Beige Book on Wednesday, but what's the thing those three have in common? None of them are voters this year. So the markets are going to have to go into the blackout period not really knowing what the Fed is thinking about a terminal rate. They figure 75 for this meeting, but not a terminal rate. And here's what the market is reflecting there, that now we go up to 4.9%, basically 5% for a terminal rate, but two-year forwards don't come down. They really stay up high because nobody really knows where this is all going.
Mike McKee, one final question. President Bostic, he does speak today, contributing to the ongoing Fed ethics scandal of the last year or so. Mike, what have we learned about his personal situation, that particular situation, and what it means for the overall story for the Fed chair?
Well, basically, he assigned his trading to a third party who did not pay attention to the blackout rules and traded during those periods. He also miscalculated what his earnings were on his reporting forms. And so he had to admit that and correct all those. It doesn't seem like a huge issue because he didn't know these trades were being made during the blackout. But it does add to the sense of what's going on at the Fed, which can't be good for their credibility.
But the optics, not good at all over the last year for this Fed, that's for sure. Mike, thank you, buddy. Looking forward to the Fed speak, and I think many of you are looking forward to the quiet period as well that starts later this weekend. Let's get you to sector price action with a big move higher underway on the S&P, up by 1.8%. Here's Abby.
Indeed, John. We do have the S&P 500 up about 2%, up nearly 5% over the last 2 days, the best 2 days that we have had going back to October 4th. Leading the way, some of those growth sectors, including materials, discretionary, tech, industrials. On bottom, interestingly, energy is higher, but it's underperforming as oil's down. Now, over the last 5 days, it's a big risk on time, especially for financials, leading the way up 6.5%, really showing you that investors are pleased with earnings. Communication services, tech, discretionary, basically your mega caps, they are doing great. Yields down, we have all these big stocks up.
Abby, awesome, thank you. What a run. The Nasdaq too, the Nasdaq up by more than 2 percentage points. Monday, Tuesday, will these gains stick? Up next, your trading diary, live from New York. This is Bloomberg. 25 minutes into the session, stocks up, yields down, equities advanced by 1.6% on the S&P, up 1.8% on the Nasdaq. Your bond market taking shape. Looks like this, 2s, 10s and 30s. Yields lower by 3 or 4 basis points on a 10-year, 397 on a 2-year, down by 3 or 4 basis points to about 440 after breaching 450 in last week's session. That's the story in the market, the price action. Here's your trading diary. President Biden speaking at noon Eastern, followed by Fed speak from President Kashkari and Bostic. Netflix reporting results after the closing bell. The Fed's Beige Book coming on Wednesday, plus more from Bullard and Evans, and Tesla reporting after the closing bell. And finally, another round of jobless claims on Thursday morning. Stock market up then by 1.8% on the S&P, and the Nasdaq up by 1.96%. Tom Keene asked me to quote the Dow for you. I'll do just that, up by 1.6%. From New York City, I'll be out the next couple of days. I'll see you Monday. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.